Hey everybody, this is Andrew from Dividend Growth Masters. Dividend yield is something that's really important to dividend investors. After all, we invest primarily to receive the dividend of a stock. Now, evaluating dividend safety is obviously a very important part of the process. We never want to invest in a dividend stock only to get dividend cut because the stock will collapse after that. You've seen it with Kraft Heinz, with General Electric, a lot of big companies that have cut dividends. The stock price generally doesn't do well. So we definitely want to avoid those types of circumstances. So one of the ways that we can evaluate dividend yield is just through what's called the dividend payout ratio. You're basically comparing the annual dividend to the amount of net income the company generated. Pretty simple, right? Obviously, the higher the payout is, the less sustainable it is. Because if they're close to paying 100% of their dividends if they're close to paying 100% of their profits as dividends, and the profit gets cut, let's say during a recession or a quarter might not go so well, then they might have to cut their dividend to be able to to preserve their cash flow. And obviously, we don't want to be in those circumstances. So a lower payout ratio is generally safer. So dividend payout ratio is primarily is one of the primary metrics that dividend investors use to evaluate dividend safety. But I want to actually talk about another form of dividend payout that should also be used to the traditional metric. So let's go over that right now with Apple as an example. So I'm just going to open their SEC filings and go to the cash flow statement. So traditionally, like I said, dividend payout compares the amount of dividends paid to your net income. But one strategy that I like to use instead is to actually compare your dividends paid to your cash flow. Because sometimes there's a difference between net income and cash flow. Because net income is an accounting line item and cash flow is just a cash flow line item. So let's look at this and see what we can figure out. So Apple paid dividends of $7 billion for the first 6 months of the year, and paid out and generated $37.8 billion of cash flow. So let's do the math real quick. 7 billion divided by 37.8. So the payout ratio is about 18.5%, and that's pretty low. So that's the alternative metric that I like to use sometimes as a modified dividend payout ratio, if you will. So the numerator, the top number is still the same. It's the dividends paid, but the bottom, instead of net income, it's going to be cash flow from operations. So which one is the better metric to use? I know a lot of you guys are going to be asking that question. Well, it really depends. Because the reason why I use this ratio sometimes is because there may be certain one-time items impacting your net income. For example, the company may have recorded a loss for a lawsuit, or a loss on inventory that they can't sell, or they might have just suffered a hurricane loss. A lot of companies wrote off a lot of assets because of the Hurricane Irma last year. So there could be large one-time items, impairments, anything like that can impact your net income on an accounting basis. So if that occurs, then the dividend payout ratio will look a lot higher than it actually is. So that's a circumstance where you would want to use the modified version, comparing it to cash flow. And obviously cash flow can also be impacted sometimes. For example, if you look at Apple, they generated a lot of cash flow this year, $14.6 billion versus $9.7 billion from non-vendor trade receivables. So there's a lot of things that can impact cash flow on a year-by-year basis too. If they stop paying their vendors at the end of the quarter, then the cash flow will look higher because they'll pay them at the beginning of the next quarter. So that's why I think these two ratios, the traditional dividend payout ratio and the modified version that I use, should be used in conjunction with one another. So that's a very good alternative to evaluate your dividend safety. Anyways, just wanted to share that with you guys, and hopefully that will save you from investing in potentially unsustainable dividend stocks. Now, if you like this video, please give it a thumbs up and subscribe so you'll be able to get all of my latest videos. I'll see you guys next time.